Hey everyone, this is Karen Waksman, founder of Retail MBA, and I'm so excited to be here with you. And Steve Little, say hi, Steve. Woohoo!
Hey.
So Steve and I have known each other a long time. We're good friends, and Steve is just amazing at what he does. Basically, he helps people sell their companies, their e-commerce businesses, their physical product companies, all sorts of other companies, and he'll explain himself a little bit more. He has a company called Zero Limit Ventures. I love that. And he's just like amazing. And so I asked him to be on this call today, this interview, to just help you guys out, because some of you guys are maybe early stages, some of you guys are more advanced in your business, and you want to eventually sell your company. And so you want to think about what it's going to take to get investors interested in you, what that sort of looks like, what questions to ask, how to prepare yourself in advance. And so Steve had so many interesting insights, and he's just amazing. And so I'm so honored to be here with you, Steve. So hi, Steve.
Hey, thank you very much. I appreciate that nice introduction. Hopefully I live up to it.
Oh, you'll live up to it. I've talked to you enough to be like, I must interview you. By the way, I just want to mention that he actually sold one of my friend's companies for way more than the person anticipated. And so like, I know for a fact that this guy's amazing, and it was a physical product company. I don't know what I'm allowed to share, but ultimately, like, I've seen him in action. I've seen him do what he does. And so that's why I'm so excited to talk to you today, Steve. So Steve, just give a quick background about you so they know who you are and why we should listen to you.
Yeah, okay, fine. Well, see, I've been in this world for about 43 years in the M&A world. I started my first business when I was 13 and sold it when I was 15 for just a little under $250,000.
That's awesome.
And had sort of a series of things through high school and college and whatnot. Ended up in the Bay Area working for top tier venture firms out there, where my job was to go into a portfolio company. They might have had 20, 50, $100 million invested, and the existing CEO might have been having a hard time getting it on an exit trajectory. And back in those days, investors were looking, the venture community was looking for, a 5 to 8 year time horizon on their capital. So if you got 3 years in and you still didn't know how you were going to get out, that wasn't really a good sign. So I just sort of cut my teeth in that world. I took 6 companies out, all of them for north of 150 million,
Wow.
or 147 to be exact. Right. So then I had built several of my own companies out there and took them out, and just sort of earned a reputation for really knowing how to do this. I enjoy it. I've retired, more times than most people, and this last time I set myself up here in Virginia and was just doing some light consulting on my porch, literally just sort of taking phone calls and helping people out. And next thing I knew, I was hanging a shingle back in the M&A world. And now we're a boutique M&A firm that handles small to medium-sized businesses. Our real significant differentiator, Karen, is that we develop a value enhancement strategy for each of our clients, so that we're able to get 200 to 500% more for the companies we represent than they would otherwise get, as you witnessed with your associates' company. So, we just have a methodology, and it works. It works every time, and we have a lot of fun, and we bring a lot of joy to the people we're supporting, and they get to sell their companies for a lot of money. But yeah, that's right. It's interesting. I want to make an observation here, because a lot of people might be saying right now, hey, I'm not ready to sell my company. And that's fine. And I'm not here to talk anybody into selling their company. What I want people to understand, and what I hope comes through in today's conversation, though, is that having an exit strategy is not about the exit. It's about the strategy. And it really comes down to this. You have to understand what grows the value of your business. I like to tell people, look, there's going to be an exit. Whether you take your company public, whether you sell your company, whether you wind your company down, or whether you keel over dead at your desk, there's going to be an exit, right? And the key is you want your business to be worth something. I mean, you've made an investment, time and money and blood, sweat and tears. You didn't do it to get a job. If you wanted a job, you'd have gone and gotten a job.
Right.
So there has to be something more to it. And so what I want people to understand is that understanding what grows value is really the critical component. You'd be amazed at how many business owners I've met over the past 40 years that have been in for 5, 10, 12 years, 15 years, and they're disappointed by what their business is worth when we do the assessment. And the reason it's only worth what it's worth is because they never got focused on what was growing value. A lot of people assume that it's revenue and earnings, profitability, and those are certainly mathematical factors associated with value. That's a true statement. But they're typically not the things that actually drive the value of the business, right? And I can offer up as evidence of this a business like Snapchat. I realize it's an extreme example, but there are literally millions of examples between here and there of the same type of thing. So really understanding what grows value means you have to have an exit strategy because they're one and the same. The way you determine what grows value, by understanding who would buy you, why they would buy you, what are they going to value, why are they going to value you, and so forth, right? And every single buyer is going to value you differently. So there is a valuation calculation, but that's not what you'll sell your business for. You follow?
Yeah, I completely get that. So the reason why I initially got excited, I mean, not that we don't have magical conversations anyways, but, I got super excited because one day you're like, you know what, Karen, if somebody, because we were talking about physical products and you were saying if somebody had a company and they were selling just on Amazon or they were just selling, on their website, they would make a certain amount of money. But if they added a few retail accounts, chain store accounts like Walmart or Best Buy, Home Depot, you were saying, what was the valuation increase just by opening up a few accounts? It was like something substantial. What were you saying?
Yeah, it's dramatic. I mean, so you can look at, for every retail channel of distribution, let's take an Amazon seller as an example, because that's really sort of the most relevant one right now.
Sure.
A company doing well, selling a physical product through Amazon, they've mastered that formula, so to speak. If we opened up 1 or 2 alternative channels, they'd be looking at a 2 to a 4, maybe a 5-point gain in their multiple. So it would take them from being 4.5 times earnings to 6.5, 7, 8 times earnings, right?
Just by adding a few retail.
Just by adding more retail channels. See, there's a simple formula at work here, and everybody that sees this is going to take this home and just, put it on a Post-it note, right? A simple formula is this. The higher the perceived risk of ownership of your business, the lower the price a buyer will pay because they're absorbing risk. The lower the risk, the higher they'll pay. So if you're a business with a single channel of distribution called Amazon, as good as it is, and it is good, right? It's still a single channel of distribution, and something can change that can affect that distribution that incurs a high order of risk on your business. We had this happen with one of our sellers last year. Some crazy quirk happened in the ranking system. They disappeared for 60 days completely. Crushed
on Amazon, like their site went down, their ability to sell things went down. Got it?
Yeah, exactly. And so all their rankings went down, everything went down. And they couldn't get back on the front page and all that kind of stuff. And the net effect of that was about $4.5 million in value. That's a huge, huge swing for a company that's worth $8 to $10 million, right? So that's 50%. So, that's all risk that the buyer would have to absorb. And now in that particular case, that's risk the buyer is going to monitor, right? Because we're in due diligence, the buyer knows what happened. They're still interested in the company, but at the original price, they're going to need to see that risk has been mitigated. One of the greatest ways to mitigate that risk is expand your channels of distribution, get more than one channel.
Meaning, don't just sell on Amazon, sell in another way, have different buyers and opportunities to show more of a balanced portfolio, correct?
Exactly, absolutely. And big retail is the easiest way to do that because you've already proven that with Amazon that the consumers want what you have.
Sure.
Right, that's already true. And if you don't go to a big store to buy something, where are you probably going to buy it? Probably Amazon, right? So there's an association that exists just psychologically. I know a lot of people who, go to the store, shop, then go to Amazon and buy. Okay, that's not the greatest thing for the retail chain, but it also goes the other way. They shop on Amazon, say, I really want to take a look at this thing, make sure it's, not something cheesy, or
Sure.
make sure it fits or whatever it is. So now the reverse is true almost as often. So they're symbiotic. So if you can establish relationships in multiple channels simultaneously, you can secure your business, reduce risk. By the way, as you, I'm sure, teach people, moving products into retail, into a wholesale arrangement can actually, really stabilize that revenue also,
Sure.
right?
It's a slower setup, but in the long term, it's more consistent if the product sells in stores. Absolutely.
Yeah. Here's one of the other things. I can tell you that one of the top objections that, in particular, private equity buyers have with Amazon sellers is it doesn't feel like a real business, right? It's one or two guys with a seller account, typically, right? There's a manufacturing back end, but that's usually done arm's length with a contract of some sort, right? Right. So, there's other stuff, but it doesn't really feel like a business. Well, you open up a couple of other channels of distribution, you deal with logistics, warehousing, and so on and so forth. Now it feels much more like a real business. The private equity buyer in particular is going to feel better about the acquisition.
Yeah, no, I get that. So, what got me excited initially was I have an Amazon business, say I make $1 million a year, right? I try and sell that business. How much could somebody without any retail accounts typically, do you have an idea of the rate? Obviously, there's more to it than that, but like how much money would they make if they sold the company they're making $1 million a year or something like that?
Well, say they had $1 million in earnings, that's EBITDA, right? Okay. So typically, through a broker network, they're probably going to get 2.5 to 3 times EBITDA. So that's, 2.5 to 3 million.
Okay.
Through a value enhancement strategy, we might get them to 4.5, 4 to 4.5, maybe 5, right? So about twice that, right?
And with a retail account, it would be what? Say.
Yeah, just assume you're going to pick up a minimum of 1 point per channel. You'll probably do better than that, but let's just say it's 1 point per channel. 3 channels is 3 points. So if you got Target and Home Depot and Costco, you're looking at now from 4.5 to 6 to 7, somewhere in there.
Wow, that is so crazy. So it's almost imperative to just add that to your channel. And yes,
It's crazy not to. It's just insane not to.
And obviously, since I'm in retail and I teach retail, this makes me happy. So I'm not going to lie. I'm doing this for my own self, whatever. But I also just think that that's really, really exciting. Now, there are some people on this call who are just going to automatically say, no way you can get that kind of money.
Yeah, I know.
No way. I even heard it from, like the amazing guys. They fight me on this. And unfortunately, I know you so well. And I know kind of your business model. Like, I actually really, really believe a lot of what you're doing. So I'd love to hear some of that. Like, how are those numbers possible? Just give me some idea.
Well, it's more to it than just the numbers. And this is the mistake that most business owners make, particularly the Amazon sellers, because in all honesty, we're talking about usually relatively young business owners that, are doing really amazing things. Don't get me wrong, but they really don't understand some of the intricacies of business finance. So they don't understand the M&A market. They don't understand markets and market making and so on and so forth. And so there is a lot to what we do. So it's not just, hey, go get channels and you'll double or triple your value. That's not exactly true. It happens, but what's critically important is the packaging that we put into the sale. So there's a fundamental premise that we operate from at Zero Limits Ventures, and we say, we believe businesses are sold, not bought. And that's very different from any other broker out there that I know of. I don't know of a single broker that's really focused on packaging and selling the business. I do know of many, many, many brokers and bankers who will take the data, crunch the data, come up with a valuation, take it out to the market and sell it for what the market will give them. That's not what we do. What we do is we package the business, we test market the business in multiple channels, just like you would a product. we see which buying channels are responding to the packaging.
Mm.
We modify the packaging until we get the kind of responses we're looking for. Then we lock the packaging down and we market make around that message, whatever that
packaging. Hold on, packaging. You're not talking about actual packaging of a product. You're talking about packaging the entire company as a whole to make it look pretty, make it look interesting, give them the data points they're looking for.
This might help you. This might help you. Think of it this way: every buyer is going to buy your business for a particular reason, and every buyer is going to value your business differently.
Mm.
Right? And here's why I say that. Let me give you a simple illustration. Let's say one buyer is interested in buying you because they want your customer base.
Okay.
Right? What they're actually saying is they have product, they want to buy a market. And they're confident that if they buy you, they'll get the market they want. This is why Microsoft bought LinkedIn, by the way. Microsoft wanted to buy the millennial market, so they bought LinkedIn, which turns out to be a foolish buy, but that's why they did it, okay? So now let's just say hypothetically that that buyer is going to pay, let's say, 5 times earnings for your business, right? Because they want the customers. There's another buyer who wants to buy your business for some other reason. Might be the product, might be some intellectual property, might be some procedures, processes, business model, might be brand, might be your employees, right?
Could be distribution.
Right, exactly. It might be distribution. So they're going to value your business differently from the first buyer.
Mm.
Now, let's say they value your business at 10 times. Right now, with no more information than that, if that was the case in my business, and you were an investor in my business, which one of those things would you want me to focus on? Would you want me to focus on getting new customers or building out my brand?
You're asking me?
Yeah.
I don't know.
If one's worth 8 and the other's worth 10, which one would you want me to focus on?
I want the 10. I want the biggest return.
Sure. Exactly. So before you give me the 100 grand, you want to make sure I'm going to take the 100 grand in brand build, not buy customers. You follow?
Okay.
Because you're going to get a 2-point gain on your money that way, right? Does that make sense?
Sure.
Okay. So that's what actually happens. So when we go out and test market the companies, that's what we're testing. We gather the information. We say, okay, so the buyers for this company, the ones that are paying the most, are over here in this category, and here's what they're most interested in. Now we go back to the company. We refine the product roadmap if necessary. We refine the messaging around the company. We refine the financial representations of the company. We refine the executive summary. We refine the documentation for the company so that it aligns better with the higher paying buyer.
Got it.
Then we go to a market of high paying buyers, and we market make there. We don't market make to low paying buyers. We market make to high paying buyers. This is something that, to my knowledge, no other banker does, right? And it's the reason we get 200 to 400% more for the companies we represent.
So what kind of companies are we talking about for physical products? Like, who's buying them typically? Just another physical product, or is like who? Well, I'm really curious about that.
Yeah, it's a great question. In simple language, simple terms, there have traditionally been sort of 2 large categories of buyers. There have been strategic buyers and economic buyers is probably the easiest way to describe it. So a strategic buyer would be somebody who's, in your market. So let's say you're selling a tea product, right? They sell things that are at least related to tea.
Okay.
Okay, let's just say. Maybe a big company, maybe, maybe a big tea, I don't know, whatever.
What? Manufacturer or what? Like a store? Like
well, it could be manufacturer. If they didn't have distribution, they wanted to buy distribution, they might buy you for that.
Okay.
It could be the company that makes, teapots, for all I know, and they wanted to start selling tea as well as teapots, right? So,
okay.
So it has a strategic implication on their business, right? Then at the other end, there's the economic buyer, and they're typically less interested in strategy and more interested in the economics of the deal. So that's sort of been the traditional landscape. Now, here's what's changed. this economic buyer is now it's more like a spectrum. At one end of the spectrum, there are the pure economic buyers. These are the guys that buy in cash flow, right? They're just buying a cash flow machine. It's just like investing in real estate. It's the same exact formula.
Huh?
I'm going to go to the bank. I'm going to put down 20%. I'm going to borrow 80%. I'm going to buy this company. I'm going to cash flow the heck out of it for 5 years. I'm going to flip it, move on to the next one, right? And they can build a portfolio of those. They get 4 or 5 of those. They go back to the bank, say, hey, we got 4 or 5 now. We want to borrow another 150 million. We're going to buy 5 more, and they keep going, right? Not a terribly interesting and exciting proposition for the business owner to become part of that formula, right? That's okay, though.
Well, some people don't care. They just want the money.
Yeah, exactly. Well, and you're going to get good money for your sale. It's just you're not going to maximize the value, right? But what's emerged in private equity over the past several years, I'd say 5, is a group of a large population of very high capitalized, well-capitalized private equity buyers that are building platforms. So they're looking much more like venture people than private equity people. And they behave in the market much more like the venture investors of old. So they're looking to buy a company and invest long-term in building that company out.
Sure.
They want to buy one, add distribution channels, add more products, add more companies. They'll acquire. I have one, they wanted to buy one company to start. He had a budget to buy 12 more companies in 2 years. Put them all together into one massive enterprise and run that enterprise. They weren't looking to flip it. They were going to run the enterprise, right? Build huge value in that enterprise, build $1 billion business that way, right? So that's a different kind of buyer. So you can see that with all 3 of those categories, they would have very different motivations for buying you. Understanding those motivations and understanding how those motivations affect the price they'll pay is the secret to maximizing the value of your business. Even if you don't want to sell it, you still need to know what those buyers would do with your business in order for you to know where do you invest the next dollar. Because if this guy will pay 150,000 or 100, if this guy will pay 10 times rather, and this guy will pay 15 times, then you better be investing where this guy wants you to invest, right? Whether you sell to him or not, you already know there's a pool of buyers that'll pay more for your business for that reason than for this reason.
You're getting a lot of data simply by talking to these guys and learning about.
Oh yeah.
Like, so you're getting like tremendous value. I was trying to think about like what happened with the person that we both know who you sold his company and stuff. And I mean, what I guess I could say he's a furniture company. Is that reasonable to say, some version of that?
Flat pack. Flat pack is good.
Whatever. So I don't know, you know, some physical product he was doing pretty well on Amazon.
Yeah.
And so
not something you would expect to buy online. How about that?
Yeah, but he was doing well. And, you know,
Really
there's a lot of these guys who are crushing online, and I still can't figure it out, but they're just doing so well. So I want to kind of like use him as an example. Like, so you kind of talked to him early on, right? And he was like, well, what if I wanted to sell the company? Like, what would that look like? And so I know that you like early discussions were like, well, you need to explore your business and start kind of lining certain things up, right?
Yeah. Yep.
And then from there, we can take it to buyers and so forth. And so I was just curious, like, when do you start organizing things, and what do you need to organize so that it just makes it easier for people to start doing it early on? I mean, I know that's a really good question. You do this individually with people, but, you know, just you got any strategies here for people who like, don't know what the heck this is all about?
Yeah, no, I do. And it's going to make people a little uncomfortable at first, and I'm sorry for that, but that's just the reality of my world. So if someone walked up to me today and said, I'm starting a business, what's the first thing I should do? My answer is develop an exit strategy. Of course, they would look at me like I was crazy. So I don't even have the business idea yet. Yeah, but that's the point. Because whatever decisions you make, if they're not oriented to what the value of the business is going to be in the future, then it's the wrong decision. All right? So now take that position, that philosophy.
So all this feel horrible now that we haven't done that.
No.
Until I met you, I didn't even think about selling my company. I was caught up in the day-to-day, you know, trying to...
That's the point. It's exactly the point I'm making. So take the philosophy I just shared with you, knowing that Well, all of our clients are businesses that exist, so none of our clients are going to follow that piece of recommendation, right? Because they've already existed.
Okay.
So this philosophy is the same. So what that says is, well, start now. I mean, there's no reason to wait. It
Sure.
doesn't matter when you're going to sell. That doesn't matter. What matters is, do you know what's growing the value of your business or not? And most don't. I'm going to go on not much of a limb. It's a big honking branch and say that at least 80% of business owners do not know what grows the value of their business.
Well, you told me once, I mean, just not to cut you off, but I never even assumed anybody would buy like my company because it's under my name and my face, and like, who the hell would want that? But you told me something that like floored me. They're like, every one of your programs is an asset. And I was like, really? Like, I guess I got that, but I didn't really get that. And I guess, and you showed me how to shift that perspective so that it could work out that way. I mean, I'm not telling my company, right, I love what I do, but like, but I know what you're saying. There's strategies that you don't even think about, right? So sorry to cut you off.
Exactly right.
I wanted to just show that as an example of.
No, that's a great example, because in essence, you're a publishing company, right?
Right.
And so that's one way we could do it. There's a million ways we could take your business and make it worthwhile, but make it a big value.
Right. We're focused on retail and physical products, but I just wanted to share that.
Yeah, that's great. And so this is the thing, is that if you as a business owner now know that, and so now you can actually look at your business through that lens and make decisions like, well, if I invest here, I'm not building value. You can still make that investment. Just know that you're not building value.
Oh, I created 12 other products after I talked to you.
Yeah, exactly. So now you're focused on building
courses.
value.
It popped out of me in 3 seconds once, I was like, what's the point? You know what I mean? Like, it's only a cash thing. And I'm like, you're like, don't be an idiot. So anyway, so I want you to know, because of our conversation, how simple and stupid that was. I just poured out. Anyways, keep going. But that's all I wanted to share. Well,
no, that's great. And that's a great illustration. So it's interesting that I wish I had a slide I could show you this. I invite people to look at my website because it's up there. But there's an interesting curve that we've charted out over the past 15 years, almost 20 years now, that shows the shape of the change in value of a business over time. And the fascinating thing about this curve is it doesn't matter what kind of business you have. All businesses have the same shaped curve. Now, sometimes it's squished up and steep, sometimes it's stretched out and shallow, but the shape is the same. And it starts out when you first hit fast growth mode, when you first start growing your business, the rate of change in value, so not the value itself, but the rate that the value is changing begins to accelerate quickly, right? More products you sell, more customers you get, more brand awareness, more market share, all those things. You're still
a business, so that's a big deal.
Value is increasing quickly.
Yes.
But what's interesting is you can continue to grow revenue, grow earnings, grow customers, grow all the key KPIs of your business, but that rate of change is still going to drag down. It's still going to start to turn down because time is in the denominator of the equation. So the longer you're in, the less effect those things are going to have, and over time it's going to drag down. That doesn't mean you're losing value. It means your growth in value is slowing down.
That sucks. I've been doing this almost 10 years, so.
Well, exactly. But now it never goes down to zero unless you crash and burn, right? Yeah. So it does turn and then starts to flatten out, and then long term it sort of goes asymptotically forever, right? But the point is this: when you think about when do I want to sell, you want to sell when the rate of change in value is at a peak, right? Because here's how it sounds. You're a buyer, right? And you're looking at my company, right? So everybody out there, you're now buyers looking at my company, right? And you're in due diligence, right? We've got a contract. You've agreed to pay for my company, but you have to get through due diligence. If every time you look at my data, I'm doing as good or better than I said I was doing, what are you motivated to do?
Buy from me.
You're motivated to move quicker.
Sure.
Well, why? Because here's why. Because every day you delay, I'm taking value. It's my value. I own the business.
Mm.
You're going to have to pay more for my business every day that I keep hitting my numbers. Every day I keep achieving my projections. The value curve is saying I'm worth more than I was yesterday. I'm worth more than I was last month, right? So I'm getting value. That's value you, the buyer, wants. That's why you wanted to buy the business, so you can get the growth in value. So you're motivated to move more quickly and buy me sooner. Make sense?
So you're saying that an Amazon company, and I'm using Amazon as an e-commerce, whatever, they start a company, they get to the $1 million mark. Is that when they should start, or to start selling?
They should already have started. They should start the day they start.
What if they don't want to sell it yet?
Doesn't matter. You still need to know what grows value, whether you want to sell it or not. That's my point.
Okay, got it.
I don't care about the exit. I care about the exit strategy. Okay? And the exit strategy should be set right from the start. Now, you can change it.
Mm-hmm.
I mean, if you get other indications further in that, hey, this is an area where I'm going to grow value more quickly, great, shift. I mean, that's the beauty of being a business owner, right?
Basically, what you're saying is that they're all about making money. Show them where they're making money. Focus on where you're making money. Just like retail. Retail is looking at your product, and they're always looking at, are you going to make me money, right? So, I mean,
if it's money, yes. I mean, for instance, I have a client who's in the augmented reality space. It's not about making money there. Okay. So the value curve has nothing to do with financials.
Well, it's customer base or whatever, right? I mean, what's their value? I mean,
it's technology.
Technology, got it.
It's technology. It's innovation and patents and licensure and so forth. So has nothing to do with the financials of the business at all.
Okay.
Right. So that's where we got businesses that all they cared about was growth, not profitability, because growth is what mattered. Revenue growth didn't matter. Growth mattered. Right. That was the point. Value growth, and how you get value growth. Back then, I mean, remember, there was a day on the internet when everybody wanted eyeballs, and all you had to do was be willing to spend enough money to get the most eyeballs. You'd get the most value.
Mm.
Thankfully, it's more complex than that now, right? Because we had, some bad experiences around that strategy. But back then, that was the value equation. Eyeballs. Okay, How many eyeballs can I get per week? The faster the rate, the more valuable I am. We sold a lot of companies during that phase, right? So everything changes over time. You have to understand what grows value. It's not always the basics of, economics. Here's a great example. I had a trucking company as a client.
Okay.
Good, solid company, right? It's worth about $27 million. A couple of brothers built it from the ground up. 12 years they're in it, slave labor, hacking away, making it work. They had some solid stuff. But because of the industry they were in the region of the country they were in, their value was capped by a multiple that was less than 1, meaning they were only worth a few $1 million, right? Because their multiple was capped at 0.85 earnings.
Because of where they're located, because of several factors.
The industry and where they were located, right?
Okay.
Well, so we went in, did our assessment, which is, sort of our secret sauce. We developed a strategy that had 2 prongs, basically.
Mm-hmm.
We identified 2 key value enhancers that they were unaware of. They existed in their business. They didn't understand that they existed in their business.
Mm-hmm.
The first one was the fact that the company, 90 some odd % of their payload was energy related equipment, meaning they were closely coupled to the energy industry.
Okay.
The second one was that they had invested capital to have a company build software for them that gave them a legitimate logistical advantage in their market, their regional market. They could actually move stuff more efficiently than anybody else. That's why they had a competitive advantage in their market. Well, what we determined was that their valuation as a trucking company was capped at 0.85 earnings, but if we rebranded the company, remade the company, there was an adjacent market that had a 7-point multiple. So we just shifted them into the energy logistics space.
That's awesome.
Right? So they became an energy logistics company. Now, day to day, they didn't change a single thing. The same drivers drove the same trucks to the same places with the same equipment, right? But they're an energy logistics company now, and they are now worth what the energy logistics market would demand.
I actually do that with retail, where one buyer, maybe it's such a competitive space with this one particular buyer, and so forth. So I actually, certain products, I'll have them completely shift their packaging, what they put on the packaging, what category it's going to be going after, and then all of a sudden it's like a wide open space where all their competitors are not even looking at that category. Yeah. You know what I mean? And so like I actually had to do that with certain products because that's going to always hit a wall.
Well, so what that says to me, Karen, is not only could an Amazon seller expand valuation by going retail through channel distribution, but they could get an extra boost going through your program because you understand those nuances, right? Because that's additional value. That's like hyper value. It's not just a channel; it's a channel with hyper value.
Well, thank you. I hope so. What about like, so obviously I care about physical products and stuff. So what about so I teach people how to, I have certain clients who make millions of dollars on Groupon. And I have clients who I've taught how to make same thing on HSN and QVC. And they also learn retail and stuff. Is it just another distribution strategy? Does it matter? Does it not? I mean, just because, how does that differentiate anything? Kind of the same? What?
Yeah, I can't. I don't know. I can't apply the same rule to everything. I don't know. I mean,
just say it's another revenue stream.
It's the same, but I'm sure there's a lot of nuances in there. So in theory, yeah. I mean, here's my view of the world. My view of the world is that we can always find ways to enhance value.
Got it.
Right. And so what my team and I do with every single client, so every engagement we undertake starts with something we call evaluation growth assessment. It is a very deep dive on the company. We spend a lot of time digging into the company, pulling out all the stuff, all the skeletons, all the numbers, all the good stuff, all the bad stuff, everything. We study every aspect of the business, right? From not just financials and products. We look at the people, we look at the organization, we look at the building, all that. And we're looking in 3 principal areas.
Okay.
One set is there's about 60 factors that create constraints to value. So these are things that already exist in your business that are constraining its value. And there can be thousands of different things. We found $3 million worth of value in a poorly constructed cap table once, right? Documentation is a big one for early stage business owners, particularly Amazon businesses, is that if they don't have everything documented effectively, it creates risk, and risk creates constrains value, right?
Okay.
So it's all kinds of stuff. It's knowing where you are in your marketplace relative to competitors. Are you growing more quickly than they are? What's happening with market share? Lots of different things. So we look at that area. We identify all the areas where you could release value by making changes to the way you're doing business now. Then we look at the value enhancement opportunities that exist inside your business today. Like with the trucking company, we found 2 value enhancement opportunities that they were unaware of, right?
Okay.
So that's the second area. The third area is we look for market enhancement opportunities. Where are you relative to the market, and is there a way for us to enhance value there? So for instance, last year we had a client where they could qualify for the new Reg A IPO regulations. So we're able to take them very quickly through a Reg A public offering, pull them public, then take them private again, and we picked up an automatic 40% value gain just in that process.
Wow.
Because it was a unique market opportunity that we uncovered in doing our assessment research.
So you're really digging deep on these companies.
Yeah, we dig very deep on the company, yeah.
Okay, so I mean, everybody and their mother is probably going to want to talk to you. So but one of the things that I promised you was that we would discuss what they need or who they are before you can help them, because you can't help everybody, right? So I don't want to torment this man, because I really want him to continue to help and give answers and so forth, future connection and so forth. So can you help me out? Tell me, what do they need to do before they even reach out to a company like yours? And wait, taking a step back. They like what you're saying. They got a business. It's early stage. Yeah, I want to know which direction to go. What do they do? Do they call you? Do they call somebody else? What do they do? Like, what should they do in this?
So I have a system set up for this, and I'm happy to commit to take callers. So
don't kill me if.
It's all good. You know, here's the only thing that I would ask is that you answer the questions on the registration form honestly. That's all, because that helps me prioritize. I'll commit to get back to everybody, I swear. But yes, I am going to commit to get back to the guy who's really ready to go before I get back to the person who's just hung their shingle last week. Okay, that's a fair statement, right? So
I'm just happy that you'll respond.
Yeah, I'm happy.
Not everybody does. You know what I mean?
I absolutely will. So there's a simple form on my website. The website is zerolimitsventures.com.
I'll put the link in here. And
yes, do that. So and then it's /access. There's a video there that's worth watching. It goes into a lot more detail than I was able to do today. Definitely worth watching. There's a downloadable free report there called the Valuation Growth Playbook that discusses a lot of what I described today.
Okay.
And then there's a registration form. You fill out that form, you're automatically plugged into my calendar. You pick a time, and we're booked, right? And I get the information that you submit on that form, and that's why I'm asking you. Be honest with that information, because if I see that there's a priority issue, we've got too many people or whatever, I'll email you and say, hey, look, I'm really booked up. Can we push this till Thursday afternoon or something like that, so that we get it worked into the schedule properly? It's not that I'm not interested, it's that I'm trying to prioritize.
Okay, but what I guess I'm care about is, what do they need to do just as a company as a whole? Like, so for physical product companies, what do I do now to prep to even talk to somebody like you? What do I need?
Well, you need to know your numbers. You need to know your revenue, your earnings, your cost of goods sold. You need to know what your business is doing, right? That's all, really.
Okay.
Because we're going to generate this. What I'm committing to people is I'm going to give you an hour of my time for free, and I'm going to help you develop a valuation growth strategy in that hour.
Okay.
Right? And so I just need to know what you're doing, and I'll come up with. I just had this happen the other day. Somebody called in, went through this process, had no idea what was going to happen, completely shifted their business model, but they went away just super ecstatic about what they had in front of them, because they had a new opportunity that they could reach in 90 days and make millions of dollars with it. So,
got it. So for those of you people who are not going to call you yet, or one day, or kind of like are in other places in life, because it does happen. Sometimes they're just starting out. It's too much. They don't want to hear you tell them that something's wrong with their business, whatever it is.
Well, for those people, we have a whole cap raise group, right?
Well, so I think it's okay. Like, sometimes not everybody's quite ready today. I'd love, if you have any, give me 3 things. A physical product company, I know this is annoying, but 3 things like a physical product you would say to a physical product company to look at or to do to just help themselves in preparation. Just throw out some whatever. I know it's annoying, but I don't care. I really want to give me some education here versus call me, because I do want to have a little bit of something.
Yeah, well,
not that you're not giving me something, but you know what I mean?
No, I understand what you're saying. I don't know that I have a lot to say. I don't mean to dodge it. It's just everything is so specific to the client. Okay, you want to understand the cost associated with the manufacturing and shipment of your products. You want to make sure you have a good inventory control system.
Okay.
You need to know those numbers. You really need to be able to nail that. When somebody asks a question about, your turn time on getting a product from China into the warehouse at Amazon or into your local warehouse, depending on how you do it, you got to know the answer to that question.
Okay.
So, I would say that know your numbers is probably the overall category. What numbers? Well, know the turns on inventory, know the manufacturing cycle time, know the manufacturing shipping time, know the manufacturing cost.
Okay.
We had a company last year that almost got destroyed because there was a strike at the docks in China or something, and kept his stuff there for, 12 extra weeks, right? In the meantime, he can't sell because he's got no inventory coming.
So how much money are they supposed to be making before they start having this conversation? Is there a number?
Not really. I mean, this is something you ought to be doing anyway, no matter what your business is. I think to have a conversation with us that's not oriented towards raising capital, you should probably be producing $1 million a year in earnings, $1.5 million. We're going to be a strain on that, but we're going to also boost the return on your business dramatically. So 2 million's better, but $1 million is probably sufficient.
So if it's less than $1 million, you can't really help them right now.
No, that's not what I said. Less than $1 million, I can help you. It's just not going to be, you're just not really going to be in a position to retain us to represent you, but we can still help you.
That's awesome. I can appreciate that. No, I want to make sure, because at least they know what they're getting into. And I'm here to get them thinking about how important it is to start looking at this early on.
Here's why I don't give absolute answers, Karen, because that's a great illustration. So I had this happen a couple of years ago where an Amazon seller heard me in a webinar and said, hey, I'm only doing about $500,000 a year in earnings. I know it's not big enough. I can't really afford your rates and so on and so forth, but something told me I needed to talk to you, and I hope you don't mind. And as we went through it, I said, well, no, you know what? As a matter of fact, you're a perfect roll-up for a client I have now. So we were able to package him up for $1.5 million and spin him off to a roll-up. He kept a 40% ownership position in the company. He's probably made $5-10 million off of that deal by now.
All right, I like to hear that. No, I got that. I also want to be clear.
I just know better than to say no. Everybody's got an opportunity. If you're a business owner out there building something, there's opportunity there, and I want to hear about it because I might have some ideas, right?
Well, in the end, adding a couple of distribution accounts.
That's a huge one in every case.
In every case. I'm working on it now. It'll help escalate your business.
Yep.
Hence my Retail MBA program and why I'm talking to you, because I think that it's a really nice marriage in what you're doing versus what I'm trying to do. And I'm so grateful for you for sharing this, and you're so kind with your time. I really appreciate it.
Thank you. Thank you for the opportunity. And I think what you're doing is amazing. You're in you and what you're doing is in every assessment report we generate to the Amazon sellers. So, that's how important I think it is. And that for a year now, we've talked about, hey, let's find one of your students who just wants to do this. We can just plug them in. Right?
Oh, I have so many, it's all timing. It's all perfect timing. This is divinely timed with everything else that we're doing. So I'm so excited for all of you people who are on this call, and I hope this helped. And I will also include his contact information below. And the name of the website is ZeroLimitVentures.com. And you said /access. Is that the page? Okay. His contact information is there. Steve Little.
Yep.
And good luck, Steve. You're going to get some calls. I tried to help you out, but you insisted on connecting.
Hey, it's all good. It's all good.
Whatever floats, man. Love to you all, and he's happy to answer any questions. And if you have any questions for me, please keep me posted. All right.
All right. Great. Thanks.
Everyone.
Bye.